Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The combination of a bearish WASDE briefing in conjunction with forecasters turning positive on the weather has sent the markets in a frenzy. Across the board today, corn, wheat, and soybean are all tumbling. And interestingly enough, as we look at the September corn contract, we can see that the market has turned right up against one of our quartile levels of about 403. The market came in and made a high exactly at that quartile level, and we can see the drop yesterday came in right at about the midpoint or the next quartile level, and our next potential support level that we're looking at sits just below at the initial quartile beginning spot. The mid-zone quartile level had been a very good resistance area across the market for some time. The market broke above, broke back down to support, reached all the way back up to resistance above, and now is coming all the way back down, and in just the last 3 days is giving up much of the gains from the past week and a half to 2 weeks. As indicated in our weekly newsletter, the market had reached up to volatility-based resistance where you can see the SR1 or the support resistance 1 level was reached 2 days ago. Once that signals off, that tells us that the market is in position to make a potential correction, or at the very least that the up move in which we were in could very well come to a pause. Last time the market reached a key level, it reached our end band at the bottom end of the chart. And you can see from here that the market consolidated for a few days, from which point it did accelerate to the upside. And now we can see that we have a volatility-based resistance overhead, which was a precursor to helping us see the potential for the market turning over here. Given that much of the move up that we had seen had been weather-related, it is not a surprise to see once the weather-related issues are starting to move aside that the market would respond in a violent way in the opposite direction. We can see a similar formation here on the December contract where the downside quartile posed very good support for the market. It came through and broke through the middle quartile and went straight up to the next quartile level, which was resistance initially for about 2 or 3 days, but it was able to break back up above. And you can see here across our 2x1 downside green angle across the top, marked off for us the key resistance from which the market was able to turn back down from. We're looking for the market then to come back down and potentially test previous lows. And at the strength at which we've seen the downdraft right now, in all likelihood, the market could very well come down to about 370 at a minimum. From this vantage point on the December contract, we can see where our support resistance band level 1 did in fact post on the chart a couple of days ago. But in doing so, we also realized that that level came in at an opportune level. Previously, we talked about a continuation pattern that had formed in this market right in the middle of the advance move. Typically, what we've discovered is when a market makes a move into a continuation pattern, that it will repeat itself on the other side. If you start at the very beginning of the extreme and measure up to the top of where that continuation pattern terminated, and then measure again from the bottom of the continuation pattern, a 100% match of that move would land us at 427. And that's part of how we had developed that potential price target of 427 for this contract. Sometimes the market will make a move, and instead of reaching that 100% threshold, it will sometimes make a target that is inside of a Fibonacci ratio. As you can see here, a Fibonacci ratio expansion of 0.618 or 61.8% lands at the high watermark for the SR1 level and the high close for this contract the following day. In doing so, once the market reached this level, this was an alternative target for it to reach instead of reaching that 427. And as you can see from here, the market has violently responded coming off of that level. Here we have the September soybean contract, and it also had a continuation pattern right in the middle of the move. In this scenario, we took a measurement of the move starting from the low, coming into the high of the move, and then taking the next measurement at the bottom of the continuation range. A 100% expansion of that move gives us a target of about 1052 and 3/4. Obviously, the market didn't quite make it to that level. Alternatively, we chose to actually take another measurement. Instead of taking the extreme of the move up, we took the extreme of the movement when it first started off at the beginning here. In doing so, we come up with a different batch of numbers. We'll clear the screen and show you what the next projection ends up looking like. Instead, we find the following results. Coming off of that low at 919 and 3/4, we take that same measurement up into the continuation pattern, measure from that previous low of the continuation pattern, and lo and behold, a 100% upward move to the upside gives us a target of 1038 and 1/4, which is precisely where the high came in before this market has turned back. Additionally, we can see that the market moved one full cycle up from the 905 and 1/4 low. One full cycle up 360 degrees plants us at 1029 and 3/4. Understandably, then the market could very well find resistance here. And when markets make a full cycle advance, it'll often come back down and perhaps test about 90 degrees below. And if it finds support near 966.5, from there the uptrend can still stay in place. If it falls below this 966.5 number, then continued weakness is possible, and from there the market could very well test 935.5 or even lower. The major range for the November contract that encapsulates much of the movement over the past several months ranges from 903.5 down below up to 1043. That 1043 high happens to coincide with the recent high that we've now seen for this contract, and now the market has finally closed this recent gap that we have seen. The next potential gap for him to fill may be the one from the beginning of the month. That remains to be seen depending on whether or not the market's able to hold above this midpoint of the quartiles of the movement here. So if this market again is able to hold above 973, 975 and turn up from there, then upward strength is potentially probable. Falling below this mid-quartile level here, then, the market then can find some potential weakness going forward. Here is another instance where the continuation pattern for this market terminated not at the one-to-one correspondence, but instead came in at a Fibonacci factor of 61.8%, where the market tagged very close to 1047.5, and from which point the market reversed back down. That 1047.5 number coincides with the 45-degree angle, which is right in between the full cycle movement up to 360 and below the 90-degree mark here. The market has turned down from there, and again right now we're looking at the 180-degree mark of 968 and 1/4 as potential good support. Depending on whether or not this market's able to hold through this level, would be an indication for us of potential strength above and continued weakness below. In the case of wheat, we used our radial arc swing technique to project for us a reasonable spot where we believe that wheat may find difficulty in getting much higher, or at the very least would find some resistance at its first attempt. That level ended up being 568 for this September contract, and part of what we've done here is we took the market swing and scaled the chart from this pivot swing low up to this high. In doing so, we then took a radial swing of a unit vector for this market. Now, as can be seen here, the market has blown through this area here. And so what we did additionally is we applied a Fibonacci ratio of 1.618 to that unit vector swing to give us this new swing above here. In doing so, we then took a tangent at the 12 o'clock space to tell us where this market would potentially find a good or reasonable resistance level. We got our 568, and as you can see from this movement here, the market basically tested it this one time and has since fallen off. We also have a few projected time factor dates up ahead, where we have about July 16 as a potential turn point. With the market now turning down into this time threshold, the market could very well move into a sideways movement for the next few days before potentially turning back up if it is in fact able to get some legs underneath it. Our confidence that 568 was potentially a good resistance level increased because at the 180-degree mark, we found that 568.5 also lived up at that area. So the market came up to that zone, found some good consolidation, as you can see over the last 2 days, has been fairly weak. Mind you, leading up into this movement here, we also saw where the market gave us our 4 to 5 sequential higher low movements. And when markets give us 4 to 5 sequential higher lows, we often see where the market can produce a very fast move to the upside. So counting off of these recent lows that we can see, all of these subsequent higher lows, the market kind of gave us a freebie here with a nice small little pullback. And from here, the market gave us a very big explosion to the upside, moving straight up into resistance as anticipated. We'll also take a look at this movement here in the eyes of an Elliott wave movement when we look at the December contract. If you recall from a couple sessions back, we believe that this market was forming what appeared to be either an ABC correction with the potential of it actually becoming an Elliott 5-wave sequence. The market had given us what we had labeled as wave 1 or A, wave 2 or B, and once the market got here, we labeled it as a potential wave 3 or C. The market then gave us a small pullback inside of here, and because it held that 490 area that we needed it to hold and turn back up and cross back above this key zone here near 508 or so, once the market was able to cleanly break through this threshold, we then became much more confident of the potential of a wave 3 movement, and the market gave us just that as it exploded on the way up to give us now what we confirm as a wave 3 movement. Also, earlier in the week, you'll find in our newsletter that we thought that this wave 3 top was a good spot for this market to pause, and from here, the market to come in and give us a wave 4 consolidation. A wave 4 consolidation will either drop down or move sideways into our next key date, and perhaps that date might be somewhere in the neighborhood of mid to late August, where the market could simply move sideways or be choppy going into this date to give us one final potential leg up into a wave 5 high sometime into mid-September. The high for the December week contract coincides with our 180-degree mark of 589 3/4. And as you can also see, the strength of the move to the downside started at our projected July 12th turn date that we had for the market for quite some time. The market has turned down with great strength from here and continues to move downside. It has already traded through 90 degrees from that 180-degree mark. And so the next level of potential support now lives at about 519. But as long as this market's able to stay above this 519 mark, which could coincide with the previous wave 1 high, then the wave 4 then is still intact and the potential for the market to make its way back up still exists. So for now, the key level for this December contract that we have in our crosshair is that key 519 number. A quick look at December cotton shows us that resistance at 69.15 held very well. The market did consolidate a bit. It was just shy of that threshold and is now moving back down again. And as it's moving down, we believe that 65 or so should be a good target for this market to reach before the downside movement's really able to settle down. September crude dropped down into our June 21 timeline. Market made a very nice low coming into this movement. From there, it actually did correct and make its way up to a good resistance point of about 47.63. And from there, the market started to actually turn back down again. We thought that the June 21 date was perhaps a significant low, but as the market started to make its way back down, part of what we had to consider is whether or not the movement up here, once the market made a retracement down into this area, if it was not able to hold the 43.90 number, that it could very well break and make a new low and test the 40.86 number. The fact that it was able to hold the 43.90 number tells us that the market has the potential to reach higher once again. And upon breaking 47.63, the market could very well make a move that is at a minimum the same distance that it did on the way up and mirror this move to the upside here, which would land it probably somewhere in the neighborhood of 49.5 or so. In doing so, if the market's able to actually break above this 51 number, then a new trend to the upside will perhaps ensue. And so what we're looking at are two key levels for the September crude contract. Both 49.5 and 51 are going to be two very important levels for this contract as to whether or not it's able to break to new highs, or if this simply is an ABC correction after a very strong down leg, at which point the market would then drop back down again. We'd like to thank you once again for joining us for our weekly market update.